Hello, welcome to the Asset Allocator podcast. I'm Aamina Zafar, funds reporter at AA. Joining me today is David Coombs, head of multi-asset at Rathbones Asset Management. Hello, David.
Hi.
Also in the studio, as always, is our very own contributing editor, David Thorpe. Hi, David.
Hi, Aamina. Hi, David.
In this week's episode, we'll explore how investors are approaching the AI revolution. So, David, as you know, investors are trying to access the AI revolution, but obviously they are rethinking some of the big players in the industry. What do you think is the reasoning behind that?
Well, there's been a huge amount of excitement, and focus has moved around quite a lot this year from the big hyperscalers, or the alphabets, the metas, those companies who are really investing heavily into AI.
Mhm.
And then we saw sort of interest in the chip makers, but also the companies that create the chips or design the chips, and so the whole kind of value chain, if you like, in terms of AI. That's where the market started, longer than 6 months ago, and you've seen some really strong returns from those areas. And then the focus moved even further into semiconductors because there's been a shortage of capacity, and we've seen some remarkable share price rises by some of those names. And then the market has literally almost kind of lost the plot, in my view. Maybe we'll come back to this in a second, but where you've seen some legacy names in the tech space, any sort of stock that was involved in the AI production has suddenly caught a bid, and it feels to me, and there's nothing I hate more than lazy historical kind of parallels, but it did start to feel a little bit a month or so ago like 98, 99, when any company that launched a website was suddenly an internet stock. And there are real earnings, and that's a pushback I keep getting. But the flows we're seeing in the market, the ETF money going into this space, leveraged ETF money, algorithmic trading going into this space, you've created some real hotspots, and it's literally lurching around from subsector to subsector. And from somebody like myself as a fundamental kind of investor, it's pretty crazy.
I mean, do you have some exposure there or some view on how to get an exposure there that is both capturing whatever structural growth is there, but is also maybe not as crazy in terms of valuations?
Yeah, I mean, the valuations are a bit pricey. They're not ludicrous, and I think, but they are based upon pretty exceptional expectations. And there's, again, I hesitate to use a cliche like price to perfection, but you do feel like there is this huge excitement, and people are willing to pay a lot for that future growth. The trouble is, if that future growth doesn't come through, those valuations are not cheap, are not just expensive; they're really expensive and flawed. So, what are we trying to do? We've looked at every area of the AI kind of hardware build out story, because that's where money is actually being spent. So it's not just expectations; money is being spent today, and you've got earnings coming through. So everything from cooling data centers to putting the kit into the tech stack in the data center, from connectors to sensors to designers to chip testing. What we've tried to do is build a diversified portfolio of hardware right the way through the AI build. And to your point on structural growth, that's where the structural growth feels it's going to be. And you've started to see this in the market, where you've seen this pivot away from the hyperscalers, who are the customers, if you like. I don't obviously include NVIDIA in that, into the picks and shovels trade. Again, another, God, I'm full of cliches this morning. So that's what we're seeing. And what we've tried to do is say, okay, we want to be in all elements. We're very diversified. What we don't want is 5 or 6 companies all doing the same thing. And you really want those companies that have a bigger moat, and a bit more, and therefore you feel it's more defensive, rather than a company that's just making Me Too type products. So memory and semiconductors, which have been particularly strong in Q2, we were kind of underweight to those, and that's hurt us actually, because they've been phenomenally performers. But they're what we would call more cyclical stocks, not structural stocks, and that's the point. So what we've done is we've bought some exposure through an ETF to semis just to capture that momentum, but it's very liquid, so we can get out pretty quickly when we need to. But what we try to do is when we're picking individual companies and want to own them longer term, we'd rather be in those structural growth winners than the cyclical growth winners. But there's no doubt the excitement in the last couple of months, has been the cyclical ones. And that's the bit that worries me the most. Because at some stage, that demand, which is being pulled forward, might start to stall. And when that happens, with all the leverage ETFs and momentum traders and hedge funds, that could end quite spectacularly dramatically.
The sort of the picks and shovels bit. I mean, look, you referenced it's a cliche. You don't normally talk in cliches, but yes, if I had £1 for everyone who's telling me they invest in the picks and shovels,
Yeah.
I'd have enough money to buy one of your funds.
And a lot of shovels. Yeah.
Yes, indeed. But do you still think that the valuations there are reasonable?
Again, you've got to do the work, right? And look global.
Sure.
And again, a lot of people have been saying, "Oh, we're going away to emerging markets." No, you're just diversifying globally your AI trade, right?
Yes,
Because
sure.
what's dominating Asian markets is TSMC, SK Hynix, Samsung. It's trying to pick the best in class in each subset. So we own Arista Networks in connectors. We own ASML in terms of lithograph, and we own Advantest in chip testing. It's just, as I say, looking for best in class. Who's got a monopoly, duopoly, whatever in that part of the hardware piece, and I say making sure it's not overlapping. Because at some stage, you want to try and ensure you haven't got that one correlated trade. Because tech is now nearly 33% of the market, right? And so it's going to have a big part of your portfolio. What you don't want is it basically being one big bet. You want to be as diversified within that as possible across multiple subsectors, probably geographies and different parts of that, as I say, the AI build.
Coming up later on Asset Allocator, we'll discuss the direction of US interest rates and UK gilts. Join us after this quick break.
Opportunity is everywhere. Access is everything. Access is expertise, guiding you with local insight. Access is discipline within a diversified approach, from traditional asset classes to ETFs and alternatives. Access is connection across a global footprint. Because when the world of opportunity is truly in reach, access is everything.
Welcome back to Asset Allocator. So, David, fund managers are obviously always talking about the interesting ways that investors can access the AI revolution. But is there actually a way to still do that now?
Well, you're kind of a bit late, I think, to be fair. I would be very cautious at the moment, to be honest.
Really?
Yeah, I think there's been so much flow, and one of the things we tend to look at is stock volatility, individual stock volatility, and sector volatility. And what we've seen in the last couple of weeks is an increase in volatility at the subsector level, and that can be a sign that momentum is starting to break down. And we've certainly seen it in the Mag 7, for example. We've seen a lot, some of the Mag 7 being pretty weak actually this year. And again, Nvidia's stalled, Microsoft's gone backwards, Meta's been very volatile, and you've seen an underperformance by the Mag 7. So I think right now, we've just actually reduced some of our memory names last week and sold some Korean names. Because that we're seeing that volatility pick up. Stocks like ARM and Applied Materials are moving 10% a day. These are big moves for big stocks, and that tells me that the flow is and that momentum's breaking down. And the danger is that momentum turns and becomes negative. Because right now the market is not moving, as I mentioned earlier, it's not moving on momentum or fundamentals. It's moving on momentum and flow of money and this excitement and this kind of bullish tone. And if that momentum switches the other way, and all of a sudden you've got leverage ETFs having to sell down, that could create significant negative momentum, and you could lose a lot of money, frankly. So I think what I would recommend if you're not in the trade now, and I can't believe there are many people who aren't, that again you focus on the names, like I was just suggesting, and be ready if there's a pullback. In terms of timing, it's impossible, right? I don't try and time markets. So what I would suggest you do is you just take a small position, either through an ETF or through an active fund or through direct stocks, in a broad number of direct stocks, and maybe you just slowly, incrementally add money to the trade, because I think you're going to get a number of opportunities. As I just mentioned, there's a lot of volatility, and actually, when you've got cash, volatility is your friend because it allows you multiple entry points.
David, the relative underperformance of the Magnificent Seven this year,
Yeah.
that's made them cheaper, I guess, optically.
Yep.
Has it made them cheap enough that they've become interesting to you or more interesting?
Um, Selectively, I think. Microsoft looks quite interesting. It's also kind of been hurt by the kind of software Mageddon, or what do they call it? Um, so software names have been incredibly weak this year. Microsoft's kind of been caught up in that, despite obviously having a more diversified portfolio, including the cloud. But also it's got Xbox and other areas which potentially AI disruption. So that's been. See, I think the Mag 7 as a collective now is almost meaningless, if I'm being honest. I think all that's breaking down into the market's being much more kind of nuanced to how it looks at those different names. I mean, actually, when you think about it, putting Nvidia, Meta, and Microsoft in one basket makes absolutely no sense.
Even, I mean, there's an argument for why Tesla
Well,
would be there now. I mean, it was a car company. Now apparently it's not a car company, but there's an argument about why that's there.
yeah, I mean, I've never owned Tesla, and I just don't quite get it, frankly, and the valuation and everything else. So I think Nvidia is starting. We own Nvidia already, just to be clear, but I do think it's interesting. We're adding at these levels. It doesn't look particularly expensive. I think Microsoft. If you're brave, I think right now, I think the trouble with a lot of these names is not a huge amount of visibility, and this goes back to my earlier comments. This is why I think you're getting all this volatility, because there is a lack of clarity and visibility. And any professional analyst you talk to, or most professional analysts you talk to in the AI space, will tell you they don't know what the end looks like. And yet all this flow of money would seem to suggest some people do, but there's a disconnect. So I think with the Mag 7, I think Meta and Alphabet could be disrupted. They're very reliant on advertising revenues, for example. But it's a brave person to bet against them.
So, David, the US monetary policy is never far from the headlines, and obviously the noise of that trickles down
Yeah.
to asset prices. What I wanted to ask you really is what's your take on where US interest rates are going?
Yeah, so I guess my view is that US interest rates may well fall next year, which is probably not that consensual. And my view here is that I never believed that Warsh, who's the new Fed governor, was some kind of Trump patsy. But nevertheless, I do think he will want rates to come down. Trump wants rates to come down, and Trump tends to get what he wants. I think there is technically a possibility that will support Warsh here. He has stated that he wants to look at the inputs, and it's about time, frankly, because some of the data that we see in the US, particularly regarding inflation numbers, which have a significant impact from what they call shelter, which is rental, housing rents, etc. And some of the survey data is pretty dubious in my view, and it has been one of the biggest factors in inflation staying elevated. So he's thinking about changing the way the inflation target from what they call PCE at the moment to I think it's mean average mean inflation. And basically what it does, it takes out the extremes at either end. That's either driving inflation up or down on a short-term basis. It's trim mean. That's what it is. Sorry. And right now that inflation number is 1% below the PCE at 2.4, which is not a million miles away from the Fed target of 2%, and certainly within the range that would be acceptable to certainly hold rates. So I don't see rate hikes, first of all, but the market has been, at one stage a month or so ago, we were looking at market was pricing in 3 rate hikes. I didn't buy into that. I thought that would be very unlikely. But I do think rates stay where they are for most of the rest of the year, and then I think there's an opportunity for rates to come down, and that would be important for two reasons actually. Because again, I don't want to particularly harbour on about the dot-com time, but what pricked the dot-com bubble was interest rate rises in 2000, increasing the cost of capital. And who's borrowing a lot of money right now? The hyperscalers, right? So that could be very negative for markets if we see rate hikes. So I think this is critical that you get this right. So what we're doing is increasing our exposure to US domestic companies because we think rates will come down next year. That will support the US economy. Europe doesn't look anywhere near as attractive, and so this is pretty critical. And I feel pretty bullish on rates.
David, it's curious what you say about rate cuts, given that arguably one could look at the US economy and see where GDP is,
Yep.
see where the jobs market is,
Yep.
and say, that there's not much of an output gap there. The economy probably doesn't need to be stimulated. So maybe it's not doing quite so well, or inflation is not quite so out of control that one needs the rate rises that were priced in. But what problem would they be solving by cutting rates now?
Well, Trump.
Well, yes.
Rhetoric.
There's definitely that.
That feels worth it to me right now, as he tries makes my life very difficult. No, but seriously, I think you're right. Employment looks pretty stable these days, but there is a lot of evidence that there's this K economy in the States, and actually, if you're below median wage in the States, you're not feeling great. And I think you've got to remember who Trump's electorate are as well. Those blue collar workers. Working in industrial parts of the country, they're not feeling well off. If you've got a 401k and you're in the professional industry services, whatever, you're pretty flush. But there's probably half of the population that aren't feeling that way, and so of course most of that GDP growth that you alert to is linked to the AI and the tech bros making a lot of money in Silicon Valley if they're still in the job. So I think it's much more nuanced, and like I said, the housing market has been really weak in the States now for years, and so I do think there is room to stimulate the economy. Actually,
Concentration risk is a big focus area for investors. What I wanted to ask you is how are you approaching diversification within that environment?
yes. Literally the last 3 years, we've seen some very narrow markets. Obviously, we've talked about the Mag 7. That was a big feature in 24 and parts of 25. And this year, it's been sort of a narrow number of stocks in kind of the semiconductor and memory space. And it's made people like me look really stupid, if I'm being honest. Narrow markets make active managers look stupid, and we have to constantly tell our clients we're not stupid. Hopefully they'll believe us. Although we do sound a bit defensive at times. But, I've been doing this job for nearly 40 years and I still believe in diversification. But frankly, diversification hasn't worked for the last 3 years. And at the beginning, the first topic we covered here, I talked about having a diverse exposure to AI. Now, if there's an AI blow up, most of those stocks will go down, but hopefully won't go down, 30, 40, 50%. I think the problem is when you get a narrow market, it supports passive investing, which supports momentum investing. And people don't want diversification. They just want returns. And no one talks about risk management anymore. Now, I talk about risk management a lot because frankly, we will underperform in this now. I've always said in a momentum-driven, narrow bull market, active managers, particularly in the multi-asset space, actually, who clearly need to diversify to manage risk, will underperform. Now, that's a real challenge. But for me, diversification is more important than ever right now. I talked about that increase in volatility that we're seeing. There are lots of red signals out there right now. And so we are spending a lot of time focusing on non-AI stocks. We talk about AI a lot. And then the US rates comes into that a lot as well. We are spending a lot of time looking at some of those industries that have been out of favor for the last 2 or 3 years.
So like what sort of
Healthcare. Med tech has been a dreadful place to invest, for example, and we're picking up some names that we probably thought we'd never be able to afford, but they've been so derated. Aerospace. Everyone's got very excited about SpaceX, but we've been looking at stocks in the aerospace who are suppliers to SpaceX, and also in terms of the changes we've seen in warfare, Russia, Ukraine, and the Iran conflict, and seeing the change towards drone technology, moving away from traditional defense instruments, and how war is conducted. And so there's lots of opportunities in companies that are much more innovative and nimble, and some of the older companies in that space who probably have been a bit complacent, still building fighter jets costing 30 million to shoot down a drone costing £10,000 from B&M or whatever. So I think there's lots of parts of the market that have just been ignored, frankly. And I think, for people like myself and for those looking at markets today, that's where there's some really interesting, exciting areas. But we just need this AI story just to kind of, I don't know, not run out of steam, because it's here for the long term, but you want it to come to reality, to come back into the marketplace.
David, at the sort of portfolio construction level, one way that one might have thought about diversification historically was geographically. So we have the US, you think, I want to diversify away. What's the opposite of the US in equity terms is kind of emerging markets. But as you alluded to in one of your earlier answers, if you bought an emerging market index today, you'd be getting an enormous amount of the AI trade,
Yes.
just different companies than you would
Yes,
in the US.
correct.
So in that world, is diversification less about geography
Yeah.
and more about sectors?
It is. And healthcare, we were looking at it, funny enough, this morning on one of our team meetings, it's dropped from 16% to 8% of the index, right? So going back to my point, there are some sectors now are very, very small, just way off people's radars, which are much bigger. I mean, that just goes to show how passive can shift things around, right? And passive is actually active in some respects, because it drives some sectors like technology. Now, I don't know what it is today. I mean, it changes on a daily basis, 32, 33, 34%. So, it is really important to when you're constructing a portfolio to look at that, to ensure that you haven't just got that one way bet.
And David, you've held some punchy positions on UK gilts.
Yeah.
But with obviously another round of drama engulfing Westminster, what do you make of that? Like, where do you see value in UK government bonds? Do you still see value there?
Well, intrinsically, yes. I mean, if take this morning, I think the 10-year gilt's around 5.03%, 5.04, because of more shenanigans in the Straits overnight. If UK inflation is hovering around, I don't know, 3.5%, 3.4%, something like that, that's a real yield of 1.5%. So actually, gilts are quite attractive on a real yield basis. But as you mentioned, there has been some drama politically. And what the markets really hate is uncertainty. I think already the previous administration didn't have huge credibility, to be honest. There's a reason why gilt yields are higher than the US and most of Europe, in fact, if not all of Europe. So we didn't enter the year in a great place, and we're now in a worse place, right? So obviously we're going to anoint a new PM this week. We don't know very much about him in terms of his policies. He was clearly a Blairite in the Blair government, whatever it was, 20 years ago, so ago. He now seems to be much more left-wing, but then that's fairly classic. If someone wants to become a Labour leader, they have to talk to the party to try and get elected. So we can't really take too much of what he said seriously, if I'm being honest. So, and that's a problem, because you can't take a view, because we have no idea what he stands for. He's not stood for an election on a mandate. So you've got someone entering without a mandate. He's going to build a new team. The markets are concerned about certain of those individuals. Ed Miliband, for example, who I think the market would probably take negatively unless he comes out with a very good speech. So yeah, we've been reducing gilt since before the Denton by-election as this uncertainty, and we're not going back in yet. And in fact, we've been diversifying into other countries and reducing our UK risk.
And David, you mentioned where yields are, and obviously that's the sort of first question one asks someone thinks about gilts.
Yeah.
But does the historic role of government bonds, of gilts, or indeed of T-bills, has been to dampen portfolio
Yes.
Volatility
Yeah.
overall? So you have your equities, you buy your... If gilts and T-bills are going to be that volatile, does that structurally change the investment rationale?
So this is a bit of a bugbear of mine. So, I mean, up until about a year ago, or certainly for the last 2 or 3 years, until this year, gilts were correlating very highly to equities. And I had my risk team telling me, you're reaching your risk budgets because your gilts and equities, you need to reduce your risk. Like, well, okay, what am I going to do then, right? And we had a debate, and we agreed to hold the gilts. And this year, actually, gilts have reduced portfolio volatility significantly. Now they haven't generated great returns, but they have dampened portfolio volatility, and that might seem counterintuitive. But part of the reason for that is that it's where your starting point is, because your nominal yield now at around 4.5% to 5% today, you're getting paid 5%, which offsets some of the volatility in the price. Sure. When yields are at 1%, of course, there's not much dampening of that vol. So because yields are now so much higher, they're actually dampening the volatility. And because actually gilts have tended to perform quite well at certain times of the year when the market's fallen, they have started to counterbalance. And so they are starting to do the job. I'm not saying it's perfect, it's not. But if I showed you the charts of my fund's relative volatility to equities over the last 2 years, it has dropped by about 30%. Okay. And that's largely due to the gilts because of the carry, that yield, that income stream you're getting from the gilts. So if you're getting 5% per annum, that does offset, say, a 7 to 8% vol in the gilt price. So it's dampening the vol.
Well, you've both raised some really interesting points, but sadly, that's all we have time for today. So thank you to David for coming into the studio.
Thank you.
And thank you to our audience for tuning in. Be sure to come back next week for the Asset Allocator podcast, which you can both watch and listen to across all podcast platforms. You can also log on to our website, ftadvisor.com/asset-allocator for more information. Until the next time, goodbye.